In today's video, I'm gonna tell you how investors short the market, and you can do it too in the easiest way possible. You probably heard or watched the movie The Big Short. It tells the story of the 2008 financial crisis and one investor in particular who made millions of dollars while the entire economy was collapsing. The investor was Michael J. Bera. While everyone else was panicking, he was doing the exact opposite. He was betting that the market would crash. And guess what? He was right. But here's the real question. What does it actually mean to short the market? And more importantly, can regular people like you and me, can we do it as well? In this video, I'm going to break it down to you in the simplest way possible. So let's jump into part one, which is just normal investing. Before we talk about shorting, you need to understand how investing normally works. Most people invest like this, okay? You buy a stock and you wait for it to go up and then you sell it for a profit. Simple. This is often called as buying low and selling high. For example, let's say you buy a stock at $50. Later, it goes up to $70 and you sell your stock. You just made yourself a $20 profit per share that you own. So that's basically traditional investing. Many investors also focus on something called as value investing, where they try to buy the stock that are undervalued at the current timing, meaning the price is lower than what they believe it's actually worth. And over time, as the market realizes its true value, the prices go up and so does their profit. Now let's jump on to part two, which is shorting. Now here where things get a bit interesting. Shorting is basically the reverse of normal investing. So instead of making money when the prices go up, you make money when the prices of the stock goes down. Yeah, I mean, it sounds weird at first, so let's simplify this with an example, okay? So let's say you own a cheeseburger company, okay? And imagine the company is called the Cheeseburger Company, right? And its stock price is $50, but you think it's overpriced. Maybe the business is bad, maybe sales are dropping, whatever the reason is, right? You believe the prices will be falling in the future. So instead of buying the stock, you borrow shares from your broker. Let's say you borrow 10 shares, okay? Then you immediately sell them at $50 each. Now you have $500 in cash, even though you didn't own those shares. So if the prices drop, which is the best case scenario, that's what you want. Now imagine the stock falls to $30, all the way from $50. You buy back the same 10 shares for $300 and return them to the broker and you keep the difference. So your profit becomes $200. And now let's say the opposite happens. If the prices go up, which is the worst case, this is something that you don't want. But here's the problem. What if you're wrong? And let's say the stock prices goes up to $70 from what it was at $50. Now you have to buy back those shares for $700. You only sold them for $500. So basically you lose $200. Now let's jump to part three. The big risk. Here's the dangerous part most beginners don't understand. A stock can fall to $0, but it can go up forever. That means your losses are technically unlimited. This is exactly what Michael J. Bera did during the 2008 crisis. I mean, it was pretty risky what he did, but it actually played out because he knew what he was doing. Now, the most important thing that you should also know about shorting is also called as margin accounts, okay? Let me explain a little bit about margin accounts. So, to short stocks, you need something called as a margin account. This means you're borrowing money or shares and you need to keep extra funds as security. So if things go wrong, your broker can demand more money. This is called a margin call. And if you don't add money, they can close your position automatically to protect themselves. So I hope this was easy till now. So let's jump on to part four on how brokers lend shares. You might be wondering, where do these borrow shares even come from? Here's the interesting part. If you have a margin account, your broker can actually lend out your shares to other traders. It's usually hidden in fine print. So there's also called as a stock lending program where you can choose to lend your shares. And why would anyone do that? That's a basic question. Why would someone lend their shares? Because you get paid. Short sellers pay a fee called a borrow fee, and part of that goes to you. So that's pretty easy to understand, right? Now we jump over to part 5, which is a safer way, which I do it as well. At times when there's like uncertainties in the market, what I go through is by doing inverse ETFs. So now, all of this sounds risky and it's a bit technical, right? That's because, it actually is. But there's a simpler way to bet against the market, the way I do it, which is inverse ETF. These are funds designed to go up when the market goes down. So instead of borrowing shares, you just buy the ETF like a normal stock. Think of it like a reverse gear for investing. Now, let me just give you a warning over here before we go a bit further. Because there's a catch. Like, inverse ETFs are meant for short-term trading only, and they reset daily. So over time, they can lose value even if the market goes down. Keep that in mind. The easy analogy about this is imagine trying to walk up an escalator that's going down for you faster than you're walking up. So even though you're moving, you're still going down overall. That's how inverse ETFs have long-term effects. Now we jump into part 6, the simple strategy anyone can use. Now here's something that most people overlook. You don't actually need to short the market to benefit from crashes. A much simpler strategy is sell when things feel overpriced. Buy when the market crashes. Market crashes happen again and again throughout history, and smart investors use these moments to buy stocks at cheaper prices and hold them until recovery. Because that's how real wealth is built. And over here on my channel, I teach you guys everything about it. Moving over to part 7, which is my final thoughts, is basically shorting, right? It can be powerful, but it's also one of the riskiest strategies in investing. It's not beginner friendly. So if you're new, focus on understanding the markets, building long-term wealth, building long-term investments, and using crashes as opportunities. Because at the end of the day, the goal isn't just to make money fast. It's about building wealth consistently. That's where everyone fails. So right now, many investors believe that we could be heading towards another major market shift. Some are even calling it the bubble. So if you understand what's happening in the market, make sure you check out my next video. And if you learned something new, make sure you subscribe, because I break down finance in the simplest way possible. And I'm also building my portfolio while I'm teaching you guys. So you can check that out on financewithbera.com, where I reveal my entire portfolio and what I'm doing myself in the current market scenario.